Hello everyone, welcome back to the Wright Research channel. Let me start with a number that should make you uncomfortable. South Korea's KOSPI index gained roughly 116% in 2026, peaking above 9,000 points on June 22nd. Then, in about 5 weeks, it gave back close to a third of that. Circuit breakers, the automatic trading halls, were triggered again and again through July. On July 13th, the index fell 8.95% in a single session. On July 28th, it fell another 10.84%. On July 29th, it dropped nearly 13% intraday, before closing down about 6%. Here's the part that makes no sense at first glance. Samsung and SK Hynix did not collapse. SK Hynix posted profits that jumped almost sixfold from a year ago. The companies at the center of this crash were making more money than ever. So, what wipes out a third of a national index when its biggest companies are printing record profits? That's today's video. And I promise you, this is not a Korea story. This is an India story wearing a Korean costume. Let's get into it. So, how did Korea get here? In our last video on Going Global, we flagged that the KOSPI had already started correcting while Japan was running. At the time, it was a footnote. It is not a footnote anymore. South Korea became the epicenter of the global AI hardware boom. Memory chips, the physical picks and shovels of the AI build-out. And Korea won that trade decisively. But that success was dangerously narrow. Just two companies, Samsung Electronics and SK Hynix, grew to roughly half of the entire index. Think about that. Half of a G20 country's benchmark, riding on one semiconductor cycle. Compare that to your Nifty 50. IT is under a tenth of the index. The rest is spread across financials, energy, FMCG, autos, pharma. When one sector catches a cold in India, the other sectors keep the patient standing. In Korea, there was no other sector. And the real fuel was leverage. That is, concentration risk. It is not a theory. It is what half an index means when the cycle turns. Concentration alone doesn't produce a 30% crash in 5 weeks. Concentration plus borrowed money does. Korean retail investors had borrowed aggressively to chase the AI rally. Margin loans hit a record of about 38.6 trillion won in late June. Total investor debt in the market had crossed 60 trillion won by the end of May. And then there was the accelerant. Single stock leveraged ETFs. Products designed to multiply the daily move of one stock, usually by 2 times. Great on the way up, mathematically brutal on the way down, because these funds rebalance daily and are forced to sell into falling markets. This is important, so let me be clear about what leverage actually does. Leverage does not just make you lose faster. It takes away your right to decide when to sell. The margin cascade. Let's explain this simply. Here's the loop. Learn it once and you will recognize it for the rest of your investing life. You borrow from your broker to buy shares. Those shares are the collateral. Price dips, collateral value falls. The broker issues a margin call demanding cash immediately. You can't produce the cash. So the broker sells your shares for you. That's not a threat, that's the contract you signed. That forced selling pushes the price down further, which triggers the next investor's margin call, which triggers more forced selling. No human is deciding anything at this point. It is automated. It is self-reinforcing. And it does not stop when valuations get attractive. It stops when the leverage is exhausted. A normal correction became a crash because the system ran out of cash, not because the companies ran out of profits. So, what lit the match to KOSPI? 3 sparks roughly at once. 1. On July 16th, the Bank of Korea raised rates by 25 basis points to 2.75%, its first hike since January 2023, citing inflation, household debt, and property prices. Overnight, holding leveraged positions got more expensive. 2. Sentiment on the AI trade cracked. Worries about excessive infrastructure capex and fears that cheaper Chinese memory chips would erode Korea's dominance. 3. Earnings met reality. SK Hynix grew profit nearly sixfold, and the stock still fell hard because expectations had been priced for a future when nothing ever goes wrong. That last one deserves its own line because it is the single most misunderstood thing in investing. Share prices do not move on whether the news is good. They move on whether the news is better or worse than what was already assumed. A stock priced for perfection has nowhere to go but down, even on excellent results. What is the billion-dollar casualty? If you want to see what leverage does to someone genuinely intelligent, look at what happened to Situational Awareness LP. This is the fund founded by Leopold Aschenbrenner, the former OpenAI researcher whose 2024 essay argued that AI progress would demand an enormous physical build-out of chips, data centers, and power. That thesis moved billions of dollars of allocation across Wall Street. And the thesis worked. Through the first half of 2026, the fund reportedly returned 439% net, according to an investor letter reviewed by the Financial Times. It was, on paper, the best performing large fund in the world. Then July happened. The fund ran leverage reported at up to 4 times. When AI infrastructure stocks corrected sharply, its prime brokers, Goldman Sachs, JP Morgan, and Bank of America, issued margin calls. On July 30th, the entire public equity book, longs and shorts, was sold in a single block to Ken Griffin Citadel at a discount. Now, an important correction to what you may have heard. The fund did not vanish. Reports suggest assets fell from roughly $45 billion to around $10 billion, and it continues as a private investment vehicle, retaining a large private stake. The public book was liquidated. The firm was not erased. But the lesson stands, and it's a humbling one. He may still turn out to be right about AI. His research was not the problem. His timing and his debt were. Foresight is worthless if you don't have the capital to survive the volatility that arrives before you're proven right. Leverage does not care how smart you are. Now, the question that actually matters: can this happen here? This is not a hypothetical for us. Nithin Kamath, the CEO of Zerodha, India's largest brokerage, watched Seoul and posted publicly that this is his biggest nightmare as a broker. His words, not mine. Why? Because of the margin trading facility book. Zerodha alone carries an MTF book of around 9,000 crore rupees, which Kamath called the biggest risk the firm has taken since it started in 2010. Industry-wide, MTF has crossed 1.2 lakh crore rupees. Brokers now offer MTF on nearly 1,500 stocks. And here is the detail that should genuinely worry you. Roughly half of that exposure sits in non-FNO stocks, small caps and mid caps, stocks without deep liquidity. You know what happens to an Indian small cap in a panic? It hits the lower circuit. Trading effectively stops because there are no buyers at any price. Now imagine you bought that stock with borrowed money. You cannot sell. Your broker cannot sell either. The debt keeps compounding while the exit door is welded shut. Borrowing to buy illiquid stocks doesn't just increase your risk, it removes your ability to leave. India's MTF market has grown up entirely in the last 3 to 4 years. It has never been stress tested by a sharp correction, not once. 4 warnings India should take seriously. Warning 1: guardrails matter and ours have helped. Korea's Finance Minister Koo Yoon-chol stood in Parliament and apologized for the rollout of single-stock leveraged ETFs, saying regulators had not thought through how they would behave after launch. India does not permit those products. Kamath himself credited SEBI for keeping the worst leverage excesses out of our market. Sometimes the regulation you complain about is the reason your portfolio still exists. Warning 2: leverage is still here, just wearing different clothes. No leveraged ETFs doesn't mean no leverage. We have enormous FNO participation, a fast-growing MTF book, and a rising habit of taking personal loans and credit to buy equities. The instrument changes, the mathematics does not. Warning 3: concentration is a personal risk, not just an index risk. You don't need to run a country's benchmark to have a KOSPI problem. If your entire portfolio is defense stocks or PSU banks or one hot theme, you have personally rebuilt the Korean index inside your own demat account. Warning 4: good earnings do not justify any price. Korea's chipmakers delivered. Their shareholders still lost badly. Great company and great investment are not the same sentence. So, where does this leave India? There are honest reasons for optimism and honest reasons for caution. Let me give you both. The optimistic case. Our index is genuinely diversified. Our earnings are distributed across banking, pharma, infrastructure, and consumption. And as global money exits overcrowded East Asian semiconductor trades, India becomes a natural diversification destination. The rotation we talked about last video works in our favor here. The cautious case. Foreign investors have been persistent net sellers of Indian equities this year. Our sentiment is still hostage to crude, to global inflation, and to the mood on the Nasdaq. And that untested MTF book is sitting there. Is the worst over for Korea? The bull case says the most violent forced selling has flushed through and valuations have reset. The bear case says leverage takes months, not days, to fully clear a system. Honestly, nobody knows, which is precisely why you manage risk in advance rather than in hindsight. So here's the bottom line. The AI companies driving global markets are by and large profitable and structurally sound. That is not what broke. What broke was leverage, concentration, and expectations detached from arithmetic. Those three things together turned an ordinary correction into a national crisis. 3 golden rules to take away. 1. Never borrow to buy illiquid stocks. If you cannot exit, you do not own an investment, you own an obligation. 2. Diversify across sectors, not just across stock names. 15 stocks in one theme is one bet, not 15. 3. Buy businesses at a price that allows for imperfection. Price for perfection means priced for disappointment. Markets correct. That is normal, healthy, and survivable. Excessive leverage is what turns a correction into a wipeout. The investors who benefit most from the next leg of growth are the ones actively managing their risk today, while everything still looks fine. At Wright Research, risk management sits at the center of how we build every portfolio, precisely because of scenarios like this one. If you want to see how we think about position sizing and diversification, stay subscribed. If this video added value, hit like, subscribe, and tell me in the comments, have you ever used leverage in your portfolio and what did it teach you? All of us at Wright read all the comments. This video is purely for education purposes and not investment advice. Markets are subject to risk, and leverage products carry the risk of losses exceeding your capital. Please consult your advisor before investing. Invest smart, manage risk. See you in the next one.